You're such an asshole.
AssholeConsulting.com. Go there if you got questions, because I have answers as long as you got money. Hey, asshole, we've talked plenty in the past on a range of topics, but today I wanted to get your opinion on a method to grow my money, so I've decided that hitting up a place like State Street or Vanguard to explore a range of portfolios will likely suit my needs best as opposed to buying real estate. But before I make the jump, I'm wondering if you can enumerate any or all of the potential downsides of putting money into index funds. I know you talked before about how stock markets are artificially inflated by baby boomer involvement, and so I will need to think critically about whether enough actual value manifests in the real world so I get a return on my investment. What is the likelihood that money in index funds will get fucked within the span of 40 to 50 years? Well, I can guarantee you they will get fucked in that time. Not permanently, but it's rare. We go through, well, what? 2007 was the stock market crash. Before it was 1999. Before that, 87. I wonder if we had a crash. I mean, every 15, 20 years there's a crash. The market always corrects. I mean, now I can't guarantee you anything with this, okay? In other words, all my advice is horrible and don't trust me and blah, blah, blah. But all we can say about the stock market, and everyone's got to understand this about investing, nobody knows the future. No one. That's why you always sign the release forms. That's why you signed a release form. Nobody knows. Now, I wish people would admit that, but they don't. But historically speaking, we always have a market crash every 15 to 20 years or so. So for 40 to 50 years, yeah, I can't guarantee you, but I'd be surprised if we didn't have a crash in that point in time. But again, you don't want to panic and sell at the bottom of the crash. You know, the traditional investment advice to buy and hold. So it's like over the course of 40, it's going to do this. Here's what I can guarantee you. The stock market in the next 40 to 50 years will both go up and down. And that's all any Harvard MBA or person can tell you. So, yeah, you're going to lose some money and then you'll gain some. It'll go up and down like it does. Sometimes it'll go down by a lot. Sometimes it'll go up by a lot. But over the course of 40 to 50 years, in theory, you would think there's enough underlying economic growth and therefore profit growth and their earnings growth, therefore the stock price would go up. But as you are probably aware, the stock market no longer goes up based on profits or dividends or fundamentals. They all go up based on how much money we print off and float around in the economy. So I can almost guarantee you, yeah, there's gonna be a crash or two in those 40 to 50 years. That doesn't mean that if you held on to them for the long run, they wouldn't provide a decent rate of return. But again, I can't guarantee you. If you invest in the stock market, you're gambling. That's how simple it is. There's a chance it will go down. Right? I think there's promise in emerging markets, but that's just a gut feeling, and I probably have no idea what I'm talking about. Yeah, unless you've studied emerging markets, you don't know. At the same time, I'm not really good at finding Davis Arinis to do a real investment with, and at the end of the day, I really just want to defend my hard-earned money against inflation while living the frugal lifestyle. Imbue me with your wisdom, oh great answer. All right, well, look, here's the thing. If you want more detail, you can take one of my online classes. And we go into the boring tedium as to why and the how and all that. But since we don't have the time for that here. The number one thing, probably the most important thing in financial and planning and investing is that it's really hard to beat the index. Okay, that's the number one thing. So you are kind of smart if you think, okay, where do I want to go? Very few professional investment managers have beat the performance of the index. And this is why index investing has become so popular, is because it just, for low cost, like if you pay someone to manage, like there's actively managed funds and then passive, which would be index funds, where we're not trying to beat the index, we're just trying to mimic it. So you don't need scores of analysts poring over annual reports and interrogating CEOs and CFOs and getting and hounding the company for financial, and you got 200 stocks in this mutual fund or 100 stocks and 100 bonds. There's none of that overhead. We are just going to mimic the index. And I'd have to take a look at my figures, but I think it's anywhere between like 80 to 85% of the investment professionals can't beat the index. So a mutual fund company like State Street or Vanguard can offer relatively cheap index funds. They still got to cover their marketing and overhead like HR at corporate. But they don't have to pay this large staff to go and actively try and beat the index and beat everybody else. So this is why if you go to Morningstar.com and you look at the expense ratios, index funds have very low expense ratios, usually listed as a percentage of net assets valued every year. And so the rule of thumb is 1% is pretty cheap. All right? And so that's what the index funds fight on. However, everyone thinks, well, I just invest in index funds and everything's fine. No, not everything is fine. Because index can go, if the stock market goes down, the indexes go down. You can lose money on indexes. So a young man like you, looking forward, diversification is the number 2. Right up there, right just like that close to index funds is diversification. Right? And diversification simply meaning you don't hold all your eggs in one basket. And this is why your instincts are correct. You don't know for a fact, but you would diversify into emerging markets or something else or some bonds. This is why they say, okay, you don't just have your eggs in one basket. You don't invest in one stock. You don't even invest in one index. You should have a diversified portfolio. And that's and then I can understand your concerns about real estate as well. But you don't want to have it all in real estate. You don't want to have it all. You want a nice diversified portfolio. But here's what's interesting with you. You say, I think there's promise in emerging markets. At the same time, I'm not really going to find Davis Marines. At the end of the day, I really just want to defend my hard-earned money against inflation while living the frugal lifestyle. All right. Well, if that's the case, then what you can do is you can go low-risk bonds, specifically Treasury inflation-protected securities, or TIPS, and just inflation-adjusted bonds. You can buy them directly from the U.S. Treasury, although it's recommended you buy them through a retirement plan like an IRA or 401k to avoid some of these tax penalties. If you want, we can go into the details, but you should just probably buy them through an IRA or a 401k. But they're adjusted against inflation. They're very low risk officially, as long as the U.S. government doesn't go bankrupt, and that'll never happen. They're very low risk, relatively speaking. Everything has risks. Don't think it can't go south. Everything can, and then inevitably everything does go south. I think the oldest company in Japan finally went bankrupt after 400 years in business. Everything goes bankrupt. Empires die. Everything. But if you're looking for inflation protection, you can invest in these inflation-adjusted securities. You could, if you still believe there's a coupling between inflation and precious metals, you could diversify into precious metals if you wanted. But there's no guarantee. We've seen inflation be low, and currencies have dropped actually. I'm sorry, precious metals. But again, it's like, what do you want to do with your money? If you just want to park it there for a meantime until you then buy a house so you don't have to pay rent, where you would make an actual investment in something that saves you a cash flow, which is an investment. Everyone thinks an investment must have cash flow, must pay a dividend or an income or earnings or something like that, or interest. Not necessarily. If you pay $150,000 for a house and you don't have to pay rent ever again, well, that's $500 or $700 a month in your pocket, net of operating expenses, taxes, and insurance and repairs. So what I would do for now, until, and I know you may not like real estate, but at least real estate, and hey, it has to be at the right point in time, but what I would do is, if this is not 401k money or IRA money, this is just money that you want to hold and keep your powder dry until you're ready to buy something, I would keep it in, you can do those inflation-adjusted bonds, the TIPS. You can invest in high-quality corporate bonds. You might lose money. That can happen. These things will typically beat inflation by a little bit. Not a lot. You can invest in U.S. government treasuries. What's the 10-year? Probably nothing good. I remember we had to look this stuff up on the Wall Street Journal. 10-year treasury yield. What do you get paid now? 10-year. 2.2%. That's barely inflation. It will in theory protect you against inflation, but inevitably you're going to start stockpiling this money. You're going to have to figure out something to do with it, and I can't tell you what that is. All I can tell you is that all of a sudden you're 30 and you're like, God, I'm sick and tired of paying rent, and you find this place. You're Red Reconnaissance man. You find, oh my God, do I love Dallas, Texas? Well, when you got a career there and maybe you want to start having a family, well, then maybe a house is that. But, you're going to cross that time when you get there. If all of a sudden you're like, well, I'd like to start investing in a 401k and IRA. All right, well, Hey, you get a match. All right. Another thing to think about inflation, I'm not just saying, there's no such thing as no risk, is the stock market itself is kind of a hedge against inflation. Because right now, as I said before, it's being driven by low interest rates, quantitative easing money, and retirement dollars. So as the government prints off more and more money floods into the market, more and more retirement dollars. You saw this in a more acute sense with the Zimbabwean and the Venezuelan stock markets, where they're printing off all this money, and the money you held is pretty worthless. But then the stock market went up. And it's not because the stock market was 10 times more productive, the companies in the stock market in Zimbabwe were 10 times more valuable. It's because they just printed off 10 times the amount of money. So I cannot make any recommendations specifically for what you to invest in. Except for if you want to just have your money safe from inflation, you can go ahead and do that and go in those inflation-adjusted bonds. The time is going to come, though, that you're going to have some money. Okay, what do I do with it? And then it's a risk. It's a risk no matter where you invest it. One of the lesser ones that's more under your control is by buying a house. Not a big one, not a fancy one. Just one you can rest your little head at and maybe rent out to a buddy, because now you have some income-generating potential and it saves your rent. But you got to research. You got to make sure the house is the one for you. You got to make sure it's, read Bachelor Pad Economics and the entire chapter on housing if you haven't done that. That'll go through everything you need to know about what to look out for, how to buy a house. And even then, there's no, all these assholes from California move into your neighborhood and jack up your taxes, because that's all those fucking parasitic dickwads know how to do. But let's wait until you get to that point in time. In the meantime, here's another thing that you can do risk-free. Pay off your debts. Guaranteed rate of return. You got credit card that charges 13%, pay off your debt. Now, maybe not you. I think you didn't have debts. Were you debt-free? Yeah, it's like if you got student loans, what is that, 6 7/8? You got credit card debt, you have a car loan, you're not going to find a risk-free investment that pays you 7%. And it's risk-free because you're the risk. You're the one that risks not paying them back. But if you throw an extra $1,000, that's $1,000 less they can apply interest to, and so you're already getting yourself an effective cash flow rate of return of 7%, not considering tax liabilities or tax benefits. So that's what I would do. I would, let's just take a look here. Do you want to live inevitably in the future? Probably somewhere in America, though I'm pretty indifferent where, as long as I'm not in the ghetto, I'm relatively safe. I anticipate a long retirement due to family history, might live over 100 years. Yeah, you guys start thinking retirement planning, too. And just looking at that, I'm likely to suffer major medical issues other than Alzheimer's, so it's likely I'm just going to randomly fall asleep one day and die. I've tried different places, and a place like Nashville seems to hit the spot. I'm kind of indifferent about big cities, and at times even slightly annoyed by the liberal politics. I don't know how you're just slightly, dude. Yeah, start travel. Let me make sure I got everything here. Start traveling around. I know everyone, you keep giving the same advice, because that's why. If people would read my books, then they wouldn't need this advice. Then it'd be cheaper. Travel around, do your reconnaissance, figure out where you want to live in the country, and then start scoping your eyes out. Keep your eyes out for property. That's what I would do. Where do you want to start inevitably setting up your base camp? And it may take years. That's fine. But if you're worried about inflation, your tips and other inflation-adjusted securities, low risk, high quality corporate bonds. But man, just pay off your debts. It's really hard to fuck that one up. I mean, it's really hard to fuck up by paying off your debts. And that does help you with cash flow in the future. That really does help your budget. So, all right. I wish I could have been more specific, but I cannot give you any specific recommendation advice. If you want, you can go through, if you want something specific, you can go through my Betterment program. It's a robo-advisor. You go to captaicapitalism.blogspot.com. If you're looking at IRAs, click on that, and what they do is they have a robo-advisor. You fill out all this information about life expectancy and all this, and it comes up with a recommendation. And like every other finance company is going to say, we ain't liable for shit. But it will give you at least a ballpark and idea. And if you don't want to do that, what a quick and dirty way to do it is look at these target date funds for the year that you're about to retire, you estimate retiring. And that will give you an idea of what kind of portfolio you should have based on conventional retirement planning. And I think Betterment, all they do is index funds. They're dirt cheap. They're just like, no, we're not fucking around. Here's the index funds based on your age, and here's the type of index funds you should invest. So that's an idea that you might want to consider. So, all right, you guys got a question? Go to assholeconsulting.com and get my book. This is for you. Get this book, Poor Richard's Retirement. Not that thick. It's an essay, truthfully. It's an essay. I'm not like Laura Southern. Like, there's my book. It's like 3 pages thick. Chris Beckloff actually spent money on that book. I'm like, did you not see the 83 pages? I mean, did you not see? All right, that's it. That's all we got. We'll see you kids later. Toodles.